Welcome back to another Tech Talk from MarketEdge.com, your source for unbiased technical stock research. My name's Rachel, and with me today is David Blake, CMT, here to discuss what happened in the market last week and what we should be looking for as we head into this week. David, how are you today?
I'm doing well, thank you.
Great, let's jump right in.
Okay, we had a very volatile week again last week. That seems to be the norm right now. And another day today to start the week out here on Monday. We have the Dow down about 750 points. So we'll get right into that here in just a second. But anyway, last week we started out, we kind of traded in a narrow range for several days. And it was a little bit of buying coming here on, what was it, Wednesday was a short week. And we saw the major averages nudge a little bit higher on some of the mega cap technology stocks. A lot of investors were waiting for the FOMC meeting minutes, which came out Wednesday. Now, they were a little bit more hawkish than expected. Surprisingly, yields were a little changed after that. I kind of thought that if they sounded hawkish, yields might tick higher and we'd see the market drift lower, but that didn't happen. And it came out after they read the meeting, the minutes, it did drop quickly, but then it bounced right back up by the close. So it was kind of a non-event. Then we came in here on Friday. We started to get a little bit of a rally on Friday. And then the Supreme Court ruled against Trump's tariffs, and that brought rates lower, actually rallied equities late, especially the foreign markets, the emerging markets and all that. And what led the rally was transportation stocks and then tariff exposed companies. A lot of that would include consumer discretionary stocks, Home Depot and companies were getting supplies from overseas and then would resell. So that was pretty nice. At the end of the week, we had 7 of the 11 sectors were positive, led by communication services because Meta and Google both had, or Alphabet both had strong weeks. And then industrial, financial, and consumer discretionary outperformed the broader market. And we had a little bit of a pullback led by consumer staples. That surprisingly was from Walmart. Walmart was down probably $5, $6, $7 last week after a good earnings report. I think it was kind of priced to perfection, and it came down. Also, materials and healthcare were weak last week. So not a lot going on, but it was enough for the NASDAQ to snap its 5-week losing streak, which was good to see. And then the Dow Jones and the S&P 500 also were able to pick up a little bit of some gains. Not a lot. The Dow Jones added 125 points. The S&P was up about 73, about 1%. NASDAQ about 1.5%. And then the Russell 2000 is up about 0.5% also. But transportation stocks were fairly strong. And semiconductors, again, outperformed a little bit. That seems to be the gist pretty much all the time. But anyway, so we came in here. You notice on the home page of Market Edge where we have a CTI is -4. And some people we have a neutral market posture on that. Some people are wondering, well, if it's negative, why aren't we bearish on the market? And as I've been trying to say the last 2 weeks, I don't see a lot of upside in this market. But for some reason, we're not getting a lot of downside until today either. And there's just so many conflicting signals in the technical condition of the market. Last week, we had the momentum index that we have that we kind of use as a support item for the CTI jumped up to a positive +4. And that's why we stayed at a neutral market posture. And again, we seem to be stuck. If you look at the S&P 500, if you go back to the chart, and I will pull that up here real quickly. Let's take a look at the SPY. Over here says mid-December, so we've gone nowhere. I mean, this is a very tight range that this thing is in. It keeps bouncing off of this. What is it? Right around 67.70, right about 67.70, 67.80. That seems to have been support here at least 3 times since the first of the year, and even going back just a little bit lower than that back in December. So not a lot of upside. It keeps getting up to around 7,000 and hits that wall and comes, right back down, and we test some support levels. Let me also put the 100-day in here. This is something today, despite the fact that we're seeing, there's this big pull down today. Again, it's kind of a conflicting message here. Here's where we ended up on Friday in the S&P 500. It actually came back up above the 50-day moving average, which was a plus for the market. That seemed to think, okay, well, once you regain some of these support and resistance levels, you usually get a little bit of a follow through. In this case, and I had mentioned it, that the market could react quite differently to start the week on the Supreme Court ruling. And that's what did happen. Despite the rally on Friday afternoon afterwards, today they're saying, well, this is going to be a problem. We don't know what's going on with trade, how it's going to affect the different companies, how long it's going to last, that kind of thing. But anyway, so today's little pullback in the S&P 500, we're down about a 1.25%. It actually came down right over here to the 100-day moving average, and that's where it's bounced off of that several times today. So if it holds that throughout the rest of the day, we probably would get a little bit of a bounce. Look at the diamonds. That's the Dow Jones. Okay, we finished up here last week over the 21-day moving average on Friday. Today we've sold off right down here to this 49 100 49, 4900 area. We're actually a little bit lower than that right now, just in the last couple of minutes. We've gone down to 846 as we speak, but we were bouncing off of the 50-day moving average for the Dow several times this morning. Again, as we're speaking right now, it looks like we did break below that, which is not good. But keep an eye on that. We'll see if that's going to go further down. You also want to take a look at some of these lows from January. Here would be one to keep an eye on. That's around 48.4. We're still about 300 points above that, so it's not a wipeout yet. I think the Dow still is positive for the year. The S&P 500, I don't believe that, or the NASDAQ is positive year to date anymore. Again, in the Dow, for some reason today, it's getting hit harder than the other indexes. The Russell 2000 also. A lot of that is because of the financial stocks have really suffered. I know American Express was down about 5 or 6%. Home Depot, again, it was one of the leaders on Friday. Now with Trump saying we're going to put in 10 or 15% tariffs across the board, it's down. It's one of the biggest losers in the Dow again today. So, financials are down 3.5%. Consumer discretionary, which would include, Home Depot and some of these retail stocks. Nike would be another one. It's down almost 3%. And industrials are down 1.5%. So it's very, very different. And then you have the healthcare is up 1%. Consumer staples are up another 1+%. Energy's up. The utilities are up. Very defensive positioning now while we're waiting for this for this little shakeout to occur here. Another thing going on today is we're hit again with the AI disruption that was going on last week. And again, part of that is the software stocks. Microsoft is down quite a bit again. The IGV, which we talked about several times. This is the software ETF here. This is a horrible chart. And again, it's taking another dip down today. CrowdStrike, I know it was down about 10 or 12%. It was one of the worst performing stocks in the S&P 500 earlier. Okay, the IGV is down to 76.64. It's down another 5%. So it's down. It took a drop today from here down to about here. So you're going to have another long red candlestick on IGV. Is this not a place where you want to jump in and catch a falling knife? Some people are saying, well, it's overdone. You should be buying in here. You always want to wait on when you see a chart like this. You want to see these things take out a previous bounce. So when the IGV gets probably up here around 85, and right now it's about 76, that would be when you may want to start to nibble a little bit on some of these things. A lot of disruption to the market. It's hard to tell what's going on. I had mentioned on Friday that actually the ruling by the Supreme Court could be good in the fact that it took away some of the uncertainty over trade policy. And then when Trump came out and said, well, I'm going to go do a 10 or 15% across the board with everybody, that just brought the uncertainty back again. So some of these support areas that we saw last week that the markets were able to bounce off of, which actually kind of supported the fact that you probably would get a little bit of a carry through this week. We're not getting that currently. Again, as people reevaluated the ruling with these new tariffs, it's going the other way. So we'll kind of take a look at that. We also talked about conflicting signals with the NYSE AD line. That's generally looked at as a leading indicator of market direction. And we'll go back and take a look at that. Made a new high again on Friday. And when that normally happens, that's usually a signal that stocks are under accumulation and you're probably going to move higher. Again, so it's a conflicting signal. That was another thing that I looked at that said, Well, when the NYSE AD line's making a new high, this right here is not a sign that this market is going down. Generally, the AD line will lead the market higher and lower. This does not look like a chart that's going to be falling out of bed anytime soon. But it's moving fast. And when you have some of these overweighted technology stocks and stuff like that, the Mag 7 stocks, that's not a good sign. Now, the NASDAQ advanced decline line is not looked at as much of a leader. But as you can see, even that last week, despite the fact that it's been having a rough time, the AD line of the NASDAQ was also improving. And that was part of the things that add to the momentum index being positive, going to a +4. That's things that we look at also. But, this stuff is not perfect all the time. And as you can see, here's the industrials. That's not a chart that looks like it's falling out of bed. NASDAQ looks like, well, maybe it's trying to bottom in here. And of course, the S&P 500 just keeps going over here, comes down to here, goes back up to there, comes back down. So we'll have to see if this is more than just a one-day in and out or out and in, whatever. But at this point, I would not be buying anything quite yet. Coming up this week, we have the State of the Union address. That could shake things up, but we'll see what happens with that. So the State of the Union. We also have talks with Iran about the nuclear program. I believe that's either Wednesday or Thursday. And that has kept crude oil prices today, at least, basically unchanged, which is kind of a little bit of a surprise. I guess oil traders are waiting to see what's going to go on with these stocks. One other thing that we're looking at, we're seeing a jump in the VIX, but surprisingly, the VIX is only up, as we're doing this right now, it's up about 21 and a half, 22. Usually before you start seeing buyers come in, you'll see the VIX at least pop up over 25, maybe between 25 and 30. A lot of times that's what brings traders in off the sidelines. So kind of keep an eye on the VIX maybe during the session. Again, with the uncertainty going on in the market, if there wasn't so much uncertainty and so many conflicting signs, we probably would have gone to a bearish stance on this market. And I would imagine we definitely will this Friday. We change it only on Friday. Otherwise, we'd probably change it today to a bearish position. So I would just be kind of looking, wait on the side there. As far as other events this week, we have earnings from NVIDIA coming out on Wednesday, which again, we'll see how that does. NVIDIA actually was up about $1 or so earlier today. And so they're now saying that they expect NVIDIA to blow out earnings estimates again. We'll see how that does. Perhaps that invigorates the tech trade again, and it can resume leadership. If that happens, today could end up just being a one and done. But I wouldn't be anxious to be jumping in here and thinking, boy, what a great bargain. I mean, you look at stocks like Microsoft when it was up to about 530, 540. Probably people around 450 and under were probably thinking, what a great buy this is. Well, Microsoft's now down over the last 52 weeks. It's down again today. It was down $7 or $8, around 380, something like this. So this is a great company, great earnings, making a lot of money, and the stock's down 30% or so. So that's still a falling knife, and you don't know how this AI disruption is going to go, how much longer it's going to go with the software stocks. So you have to wait till some of this stuff gets worked out rather than just jumping in. Now everything's cheap until it gets cheaper, and that's problem with the market. If you own Microsoft at 450 and now it's at 380, you're thinking, boy, I loved it at 450. I love it more even more at 380. And that's not a reason to buy the stock. You wait until things bottom out and then start to resume their way back up again. You don't catch a falling knife, which is what we have right now in a lot of these industries, especially disruption industries. So I would be very just cautious in here. Know that without a doubt, we'll be moving to a bearish market posture here, which should last all the way through March. The way the CTI is right now, it looks like the market should probably bottom out sometime towards the end of March. And then that might be a time that, maybe we can start to see some of the cycles come in and have more of a bullish stance. But again, I don't mean to sound too negative on everything right now, because of all the conflicting signs, we could get a rally tomorrow morning back up to some of these resistance to support lines. But I would give a little bit of space in here, because when you get a good signal, a bullish signal, usually that will work out. But when they don't work out, then you have to take notice and say, okay, generally this should be happening when this happens. But if B doesn't happen when A happens, then that means that your A signal is conflicting with something else, and you want to wait until you see what's supposed to happen. And that's what we're getting right now, just to sit back and watch.
Very good. Is there anything else we should know before we head into the rest of this week, David?
No, I don't think so. I think this is one of those weeks where if you haven't leveraged yourself to the downside a little bit, maybe you look at some stuff, maybe some selling some calls, or possibly you can buy some of these leveraged short positions on the SPXS or SDOW or SQQQ, some of these. Well, while they're starting to pull down, because I do think that now that we're starting to roll over here, that we probably will go down a little bit lower, from here.
Great. Well, thank you so much for this, David. We'll keep an eye on this and look for that change to the CTI on Friday and any comments you have between now and then in our market letters. Thank you so much to everyone for watching today. If you have questions for David or anyone else on the Market Edge team, feel free to reach out by dropping a comment below if you're watching on YouTube or sending us an email to support@marketedge.com. We'd be happy to help you out. If you would like to try Market Edge for yourself, your first 2 weeks are free. You can sign up at marketedge.com. That's it for this week, and we'll catch you next time. Thanks, David.
All right, kiddo. Bye-bye.
Bye.